It might sound like clickbait, but I actually made $1,177.25 in one single day. Completely passively. I didn't have to lift a finger. And here's how. Investing. That's literally it. I have a stock portfolio and it was a green day. I don't really know how else to answer. I just didn't want to clickbait. But today, I'd like to look at a few stocks and share some analysis on them. So the first stock is the biggest position in my account, and it was the biggest mover on this green day. But the stock was Constellation Energy, or ticker CEG. This one's actually a play from Nathan Robert, someone I've mentioned in a previous video, but it's a nuclear energy company. And one of my favorite things about this company is that they own over half of all the nuclear plants in the United States. As demoralizing as it may be, they're basically a monopoly within the energy sector. But, they're going to exist regardless, so you might as well make some money off of them. But just a quick dive into their financials, their total revenue in the most recent quarter was $5 billion. EPS is 2.7, which is a surprise 2% beat, and up over 2,000% year over year. Net profit margin is up over 2,000% year over year, and cost of revenue is down 25% year over year. I've started to slowly become more of a dividend growth investor. And another thing that I really like about this company is that they can easily afford their dividends. Their dividends cost $110 million per quarter right now, and their net income in the most recent quarter is $853 million, down from the previous quarter before that, but it's still up over 2,000% year over year. So just think about that. Just in the most recent quarter, their net income can cover the entire year's worth of dividends. They could easily raise their dividends multiple times over. But if you're not getting great returns with dividends, you're getting great returns with non-cash dividends. And what I mean is this company buys back a lot of its own stock, and now is the time. Trailing 12 months PE is 17, which is slightly under the industry average, if I'm not mistaken. The forward PE is 21, and correct me if I'm wrong on this, but that basically means we've been trading at a quote unquote undervalued price, and we're expecting the price to increase in the near future. Now, the past couple of quarters, they didn't buy back shares because we were at all-time highs, but now we're down about 41% from the highs. If that's not a discount, I don't know what is. They've been sitting on $3 billion in cash in the most recent quarter, and I can easily see them putting a lot of money into stock buybacks. And to be honest, I really don't see this stock going too far below $200 a share. And if you want to throw in some technical analysis, on the weekly and the monthly chart, we're both at a very strong support area. I know some people just scoffed because I threw in some technical analysis on there, but I think it's good to combine technicals and fundamentals. But outside of that, I also have their investor presentation pulled up right now, and I found some things that I like. So I already believe nuclear energy will be a big player in the energy space years down the line. But what I didn't know is that not only is it the cleanest form of energy, but it also has the second lowest mortality rate out of all the other types of energy production. Their revised guidance puts their EPS up about 40 cents, and they expect to CAGR their 2024 EPS 10% every year until at least 2028. So those are just the major things that I was looking at. And I know it's an investor presentation. It's supposed to make me feel better, but it's doing a pretty good job at that. So just scrolling through, we can find some more things. U.S. electricity demand is forecast to grow twice as fast through 2030 as it has over the last decade. That's pretty understandable. In a similar vein, AI and data center growth will drive power demand. They say in the next 5 years, consumers and businesses will generate twice as much data as all the data created over the past 10 years. That sounds pretty outlandish, but at the same time, more people being born, more AI being used, all that stuff. I can see it. I can see that happening. AI data center racks could require 7 times more power than traditional data center racks. Major tech companies are expected to invest $1 trillion in data centers over the next 5 years. I mean, I know all this stuff sounds like it's in fantasy land, and maybe some of it is, but regardless, it's a company with a path, and they're doing pretty good now. I can see them staying around for the future. So, CEG has good financials. They've had a nice pullback if you look at the chart. They're a powerhouse in the nuclear energy space, and I think that sector has room to grow as technology and the population grow. Overall, this seems like a very good opportunity to purchase this stock. Seems like a very good stock to purchase. That's stock number one on the list. The next stock was going to be inspired by Dividendology, and it was going to be Home Depot, mainly for their dividend growth and their return on invested capital, which I weighed heavily. It has consistently seen an average of 20% or more over like the past 10 years. But I looked into some of their financials and I didn't really like it so much. So I decided to look at a company that's very similar to them, Lowe's. Now, I don't currently own this yet, but I'm going to be buying it very soon. But here's what I like about Lowe's. Depending on how you think of it, Lowe's was either founded in 1921 or 1946. So regardless, it's been around the block a few times, and I really don't see it going anywhere anytime soon. We will always need to build and repair stuff, but Lowe's financials seem better than Home Depot's. Now, I couldn't find their return on invested capital. I wish I could have. I really wanted to. But anyways, according to January's quarterly financials on Google, their net income is up year over year, their net profit margin is up year over year, and their cost of revenue is down year over year. So basically, they're making more money and it's costing them less to do so. Aside from this being a stable company, they're a dividend king. They've been consistently paying and raising their dividends for 61 years. And one of my favorite things to hear as I'm becoming more of a dividend growth investor is pretty obviously their dividend growth percentage. Lowe's has a whopping 17.99% 10-year dividend CAGR. That heavily outpaces inflation. Your money will be worth more and more each year. Not only that, but their cash flow payout ratio is only 23.83%. That means for every $100 they make, they're spending $24 to pay dividends and then have 76 to do whatever else they want in the company. As I was researching Lowe's, I found Dividendology also made a video about them like a year ago where he used the average of several models to calculate a good buy price. Now, I know a year's a long time, but the stats haven't changed too much. But he figured the intrinsic value was about $236 a share. With a 10% margin of safety, that number comes out to $212 a share, and with a 20% margin of safety, it came out to about $189 a share. I'll link his video if you want to see the models he used, but right now Lowe's is at a key weekly and monthly support level. It's down around 23.7% from its highs, and it's at a price of $219.17 a share. Oh, and they also do stock buybacks. Now, the last stock in this list is one of my first and longest held positions, Waste Management. Now, this doesn't have insane dividend growth, and it really doesn't have insane growth either. It's somewhat of a slow moving company. With that being said, this is a company I have very high faith in because we're always going to need our trash taken care of. Because of that, this company is also very recession resistant. If there's any company I can be almost 100% certain on staying around, I would definitely go with this one. Aside from that, they have very consistent net income. The past 4 quarters are all up year over year, with the most recent quarter being up 21%. Profit margins are up, earnings per share is up, cost of revenue is also up, which I'm not a big fan of. But, I'm willing to look past that. I got a lot of conviction in this company. They've also been paying dividends for 23 years and growing dividends for 21, while having a cash flow payout ratio this year of 22.9%, which I really like to see. While it's not amazing dividend growth, their 10-year dividend CAGR is sitting at about 7.3%, which still outpaces inflation. We're at all-time highs right now, but if we can get into the 200, 205 price range, I will definitely add more size. I think Waste Management is just overall a good quality company to have in your portfolio. So I'm kind of new to this. I've been trying to teach myself, but if I made any mistakes, please let me know. I'd love to learn more, but these are just some of my top stock picks for the coming years. I really don't think I'm going to be selling any of these except maybe CEG, but that'll be years into the future.